School of Management Studies IGNOU presents an audiobook on the course MMPC 014 Financial Management for MBA program. Presenting Block 1 Financial Management and Overview. Unit 3 Risk and Return. After completing this unit, you should be able to explain the concepts of risk and return, describe the genesis of total investment risk, distinguish between systematic and unsystematic risk, and identify the factors that affect risk in investment in equity shares. Introduction. Concept of investment risk. The term risk is commonly used in the investment sector. In everyday life, the word risk frequently connotes an unexpected negative outcome. When you say it is risk to drive on a certain route, you are implying that driving on that route could result in an accident. The term risk in the context of investments, on the other hand, has a different meaning. It not only denotes the possibility of a negative outcome, but also the likelihood of a less positive outcome. As you are aware, risk and return are interrelated. A person purchases a financial asset with the intent of receiving a profit. The investment decision would be based on an anticipated return which may be realized or not. The risk associated with an investment decision is the possibility of an unexpected negative or adverse return. Almost every decision involves some level of risk. When a manufacturing manager chooses equipment, a marketing manager creates an ad campaign, or a finance manager manages a portfolio of assets, they are all dealing with uncertain cash flows. The financial analysis includes assessing risk and incorporating their likely effect into the financial decisions. The variability in return from security is described as a risk in theory. On the other hand, security that generates consistent returns over time and the returns are assured based on some type of guarantee, usually sovereign guarantee, is referred to as a riskless security or risk-free security, whereas security that generates inconsistent returns over time is referred to as a risky asset. For example, Rupees 1000 at 12% 2020 Government of India loan and Rupees 100 at 14.5% 2005 TISCO non-convertible debentures. The government loan would have zero risk because the government system does not collapse and interest and principal repayments are guaranteed. In the case of TISCO debentures, here are protective covers in the shape of corporate assets and sustained solid financial performance. But there is a risk of poor performance and default. For many investors, investment risk is a major source of anxiety. When a secondary market fails to respond to rational expectations, the risk component of such markets is rather large and most investors are unaware of the true risk involved in the investment process. Risk aversion is a characteristic that many small investors have in the secondary market. Small investors in particular look to the market for a certain return, and when their expectations are not satisfied, it has a detrimental impact on their morale. As a result, these investors prefer to put their money into assets that will give them a small return on average rather than securities that may give them a large return on average but fluctuate wildly. There are also risk-taking investors in the financial system. Speculators are risk takers who choose to invest in securities that provide large returns even though the certainty of such returns is relatively low. In the market, they are also known as risk takers. A secondary market requires both risk takers and risk-averse investors. Evolution of risk connotations. In the 21st century, analysts would utilize financial statement data to assess the risk of a company's securities. They utilize the quantity of debt held by the company as a broad indication. Their rule was that the bigger the amount of debt, the riskier the securities. In the 1962 edition of their seminal work titled Security Analysis, Graham Dodd and Cottle, who are considered pioneers of security analysis as a field, emphasized margin of safety as a measure of risk. They believed that security analysis should compute a security's intrinsic worth, which is independent of its market price. The intrinsic worth of an asset would be the security analyst's own opinion based on its earning power and financial attributes without reference to its market price, they claim. The margin of safety was defined as the difference between intrinsic value and market price, and the risk assessment criterion was, and I quote, "The bigger the margin of safety, the lower the risk," unquote. Other than the standard deviation, measurements such as range, semivariance, and mean absolute deviation have been employed to assess risk. However, the standard deviation is widely accepted since it allows probability statements for a wide range of distributions. This total is decomposed into multiple components by the investment risk, which can be done in two ways. The first is to divide total risk into systematic and unsystematic risk, and the second is to divide total risk into components, each of which has a causal force as its source. Inflation, interest rates, market sentiment, and other pervasive risks can be divided into two categories: those that affect all securities to varying degrees, such as inflation, interest rates, and market sentiment, and those that are specific to a particular security, such as financial risk and business risk. When return variability moves with the market, it is known as systematic risk. Such a risk is impossible to eradicate, and it is a big source of anxiety for investors. When prices rise, for example, all enterprises are affected in terms of their expenses and realizations, which affect return variability. This will be a market phenomenon and would tend to stay for all. In calculating his projected rate of return, the investor would seek compensation for this risk factor. Non-systematic risk, on the other hand, occurs when returns vary due to firm-specific factors such as failure to get a prestigious foreign contract or a higher exposure to the risk of default in payment of interest charges and debt obligations. This type of risk is not taken into account when calculating the expected or needed rate of return because it can be mitigated with a diverse portfolio. Sources of risk. The risk associated with an investment is always a concern for an investor. He is confronted with several inquiries. To comprehend risk, he or she needs to be aware of: Number 1. What makes an investment risky? And number 2, what are the various elements or sources of risk that the investments are exposed to? Variations in investment return can be attributed to a variety of factors. Each of these sources carries a certain amount of danger. We have mentioned already that there are various causes for future returns differing from predicted returns. Now, let us focus on understanding distinct risk sources. There are several sources of risk in investments. They are: number 1, market risk. Even though the company's earnings do not change, market prices of investments, particularly equity shares, may fluctuate in a short period. The causes for this pricing change could be several. Investors' attitudes towards equities may change as a result of one or more factors, leading to a change in market price. The return on investment varies depending on the market price. This is referred to as market risk. Market risk is the variation in return caused by changes in the market price of an investment and arises as a result of investors' reactions to various key occurrences. The market prices of equity shares are affected by a variety of social, political, economic, and firm-specific events. Another aspect that influences market prices is market psychology. Market prices for all shares tend to rise during bull periods, while prices tend to fall during bear phases. Business cycles have been discovered to be a primary driver of the timing and extent of bull and bear market periods. This would imply that the ups and downs in the stock market correspond to the economy's expansion and contraction cycles. Pessimism is triggered by a bear market and prices plummet on a large scale. Although there may be exceptions, empirical evidence suggests that it is difficult for investors to avoid losing money in down markets. As stated earlier, market risk can be characterized as systematic or non-systematic. When a number of systematic forces cause the majority of stocks to rise during a bull market and decrease during a bear market, it is said to be a market situation called systematic market risk. As is stated earlier, a small percentage of securities would be negatively associated with the current market trend. For example, firms which have been granted a valuable patent for gaining a profitable additional market share may see their share prices rise despite the market's general gloom. Such unsystematic price swings are diversifiable, and the securities that are exposed to them can be managed with other shares, resulting in a diversified portfolio. Number 2, interest rate risk. The interest rate influences the return on securities in a variety of ways. Because investors always compare risk-free return with expected return on investment, it has an impact on the expected or required rate of return. When the interest rate rises, the expected or needed rate of return on other assets rises as well. Thus, the interest rates on risk-free government securities and the general rate of interest are linked. The rate of interest on other bond securities rises or falls in tune with the risk-free rate of interest. Interest rate risk refers to the variation in return induced by market price changes in fixed income products such as bonds and debentures. The price of a security, that is, bonds and debentures, is inversely proportional to the level of interest rates. Existing securities prices decline when the interest rate rises and vice versa. Changes in interest rates have a direct impact on bond and debenture prices as well as an indirect impact on equity share values. Number 3. Inflation risk. Inflation risk is the variability in the total purchasing power of an asset. It arises from the rising general price level. Thus, it refers to the unpredictability of the buying power of cash flows expected from an investment. It depicts how inflation or deflation affects an investment. Interest rates on bonds and debentures, as well as dividend rates on stock and preference shares, are expressed in money terms, and if the general price level rises in the future, the purchasing power of cash, interest, or dividend income will certainly drop. If the money rate of return is equal to the rate of inflation, the investor obtains a zero rate of return. Many investors feel that despite inflation, they will be better off if the market prices of their financial assets rise. After all, money is increasing, they argue. This is nothing more than a monetary delusion. Take, for example, a circumstance in which the market price of security you own doubles and the overall price level quadruples. Would you consider yourself to be wealthier just because your control over money has doubled as a result of selling the security? True, you get more money than before, but you can only buy so much with it. You cannot deny that as a result of a fourfold increase in pricing in general, your control over goods and services, which is the ultimate goal of all investment decisions, has eroded. Thus, the risk of inflation originates from the uncertainty of the purchasing power of the money to be gained from future investments. Number 4. Business risk. Business enterprises work in a constantly changing environment which makes expected income to fluctuate. A change in government policy on fertilizer subsidies, for example, could harm a group of fertilizer companies. Similarly, a competitor's conduct, whether domestic or foreign, might have an impact on other businesses. While the aforementioned changes in the environment are the result of specific entities, several other elements alter the operational environment but cannot be traced to a particular source. For example, many businesses are affected by the business cycle and their earnings fluctuate dramatically from one year to the next. Steel, auto, and transportation companies are all affected by these business cycles. It might be difficult to determine if a company's risk is systematic or not. A diverse portfolio of assets from several industries can help to mitigate such company-specific risk to a large extent. Portfolios with a few firms or companies from a few industries, on the other hand, would be vulnerable to such business risk if all sectors of the portfolio are affected by environmental changes. Number 5. Financial risk. When the company capital structure includes debt, financial risk occurs. Debt creates a fixed liability which increases the income variability available to equity stockholders, and it is not always a negative thing. It will boost profitability when the company performs well and stock investors receive a higher return than would otherwise be available. Because of the fixed liability, debt causes problems in poor times. If the company fails to satisfy its debt obligations, the managers will have to spend a significant amount of time convincing lenders to accept a delayed payment, wasting valuable managerial time in the process. The default easily spreads negative information about the organization, and the corporation is plagued by problems on multiple fronts. It may be unable to obtain financing from suppliers, and some of its best employees may depart. Customers will also favor organizations with strong financials to minimize supply disruptions. However, until the loan is completely secured, too much debt causes challenges for even current debt security holders. Even in such circumstances, due to the lengthy legal process, seizing assets and selling them to fulfill their liabilities is challenging. Number 6. Management risk. Management risk is the portion of total return variability caused by managerial actions in companies where the owners are not the managers. Regardless of how experienced the management team is, there is always the risk of making a mistake or making the wrong decision. Owners, investors are rightfully enraged when executives are paid large salaries and bonuses and are given ego-boosting non-income spendings such as fancy automobiles and lavishly equipped offices, but their poor decisions put the company in serious trouble. Management errors are the primary causes of the management risk component of overall investor risk. There are so many of them that it is difficult to keep a track of them all, let alone classify them. Nonetheless, certain potential managerial blunders can be identified. Ignoring product obsolescence is one of the biggest mistakes that management can make. In reality, adequate R&D expenditures must be made and alternative products must be promoted before the old one's life cycle ends. Firms with a single product line will be more vulnerable to this risk than those with a diverse product range. A company's reliance on a single large customer also may cause this risk. Many software firms are now dealing with this issue and are attempting to diversify their customer base as well as their geographic exposure. Another example of management mistakes could be how a correct choice is handled when it is unfairly criticized and even litigated in court. For example, a vehicle company produces a fuel-efficient tiny car well ahead of its time. Some zealous consumer advocacy group files a lawsuit because they perceive that user safety is being jeopardized. The company then announces the product's discontinuation, leaving investors to endure the loss of their capital as well as future revenue losses. Please keep in mind that these examples are merely examples and the list might go on indefinitely. Number 7. Agency theory and management risk. The research that aims to understand the core motives of owners and managers is a recent trend in the field of explaining management risk. It has been said that owners work harder than managers who do not own a share of the company. Furthermore, because they are hired employees, non-owner managers have tremendous incentives to consume non-monetary perks. According to the emerging view, owner non-managers pass full authority to non-owner managers who then work as principal agents. As a result, there is a conflict of interest between owners and managers, and the latter may abuse the authority entrusted to them to the owner's detriment. As a result, reasonable investors would pay a greater price for shares of owner-managed companies than for shares of employee-managed companies. The difference in prices between the two sets is known as the agency cost. It should be noted that though the hypothesis has been criticized, it is becoming more widely accepted. Number 8. Liquidity risk. The inability of a seller to sell assets without offering price reductions and commissions is known as liquidity risk. It is simple to rate assets based on their liquidity. A country's currency unit is immediately saleable at par with no requirement for a discount or other concessions. The next most liquid asset class is government securities and blue chip stocks. Some tiny and lesser known corporations, debt securities, and equity shares are less liquid, if not illiquid. Due to lack of liquidity, investors are forced to sell securities at a lower price than the current price, especially when the quantity to be sold is significant. Therefore, when choosing securities, investors must consider the liquidity risk also. Number 9. Social or regulatory risk. The social or regulatory risk emerges when an otherwise successful venture is harmed by unfavorable legislation, a harsh regulatory environment, or in the worst case scenario, nationalization by a socialist government. Price controls may lower the revenues of industrial enterprises, and rent controls may largely eliminate the value of rental property. The social risk is essentially political and thus unpredictable, but no industry can expect to be immune to it under a representative democracy based on rising government interference in corporate matters. Number 10. Other risk. The monetary value risk and the political environment risk are two further categories of risk, particularly when investing in foreign assets. The investor who purchases foreign government bonds or securities of foreign firms in the hope of obtaining a slightly better yield than domestic issues bear the calculated risk of: Number 1. A change in the foreign government and repudiation of outstanding debt. Number 2. Nationalization of business firms, that is, seizure by the government. Or number 3. The desire but the inability of the foreign government or corporation to handle its indebtedness. When investing in international securities rather than domestic securities, the investor should carefully consider the higher risk associated with international investments against the projected return, which could be in the form of interest, dividends, or capital gains. Risk preferences. Managers have different perspectives on risk and firms. As a result, defining a generally accepted threshold of risk is critical. The three basic risk preference behaviors are risk aversion, risk indifference, and risk seeking. Most managers are risk averse and they demand that any increase in risk be accompanied by an increase in reward. When it comes to taking risk for their company, they are more conservative than ambitious. As a result, a risk-averse financial manager is postulated who demands larger returns for more risk. Types of risk. The first three types of risk in investments, namely market risk, interest rate risk, and inflation risk, are external to the firm and therefore cannot be managed. These are all pervasive and have an impact on all businesses. The business and financial risk, on the other hand, are controlled and internal to a certain corporation. Based on this analysis, the risk may be classified into systematic and unsystematic risk. Systematic risk. The portion of return variability induced by factors impacting all enterprises is referred to as systematic risk. Diversification will not be able to mitigate such a risk. Some examples of systemic risk are: Number 1. The government changes the interest rate policy. Number 2. the corporate tax rate is increased. Number 3, the government resorts to massive deficit financing. Number 4, the inflation rate increased. Number 5, the central bank of the country promulgates a restrictive credit policy. And number 6, government fails to attract FIIs. Next is unsystematic risk. The unsystematic risk is the variation in the return of an investment owing to factors that are specific to the firm and not to the market as a whole. Unsystematic or unique risk is a type of risk that can be completely mitigated through diversification. Some of the examples of unsystematic risk are: number 1, workers declare a strike in a company. Number 2, the R&D expert of the company leaves. Number 3, a formidable competitor enters the market. Number 4, the company loses a big contract in a bid. Number 5, the company makes a breakthrough in process of innovation. Number 6, the government increases custom duty on the material used by the company. And number 7, the company is not able to obtain an adequate quantity of raw material used by the company. Total risk is equal to systematic risk plus non-systematic risk because the two components are additive. In most cases, systemic risk is calculated by comparing the stock's performance to the market's performance under various scenarios. For example, if the stock appreciates more than other stocks in the market during a good period and depreciates more than other stocks in the market during a poor period, the stock's systematic risk is more than the market risk. The market systematic risk is 1 and systematic risk of all stocks is stated in terms of the market index's systematic risk. This is accomplished by measuring a value known as beta. When stock returns are regressed on market index returns, the beta of the stock equals the beta of the regression coefficient. If a stock's beta is 1.50, it is likely to see a price increase of 1.5 times as compared to market return of 1. At the same time, if the market fails by a certain percentage in a terrible period, the stock is predicted to fall 1.5 times as much as the market. Risk versus uncertainty. Although the terms risk and uncertainty are sometimes used interchangeably, their perceptions differ. Risk implies that a decision maker is aware of the probable outcomes of a decision and its associated probabilities. Uncertainty refers to a scenario in which the likelihood of a particular occurrence is unknown. Investors strive to maximize expected returns while staying within their risk tolerance. The degree of risk depends upon the basis of the features of assets, investment instruments, and the mode of investment. Causes of risk. Some factors which can be stated to cause risk in the investment arena are: number 1, wrong method of investment. Number 2, wrong period of investment. Number 3, wrong quantity of investment. Number 4, interest rate risk. Number 5, nature of investment instruments. Number 6, nature of industry. Number 7, nature of business in which investment is made. Number 8, national and international factors. And number 9, natural calamities, etc. Measuring historical return. The total return on investment for a given period is total return equals to cash payment received during period plus price change over the period divided by price of the investment at the beginning. The amount received throughout the period could be positive or negative. The difference between the ending price and the initial price is the rupee price change over time. This might be positive, that is, the ending price is higher than the beginning price, or zero, that is, the ending price is the same as the beginning price, or it can be negative, that is, the ending price is lower than the beginning price. Hence, the equation becomes R is equal to C plus in brackets PE minus PB divided by PB, where R is equal to total return over the period, C is equal to cash payment received during the period, PE is equal to ending price of the investment, and PB is equal to beginning price. To illustrate, let's consider some information of an equity stock. If the price at the beginning of the year is rupees 70, dividend paid at the end of this year is rupees 5, and price at the end of the year is rupees 80. So, the total return on this stock is calculated as 5 plus in brackets 80 minus 70 divided by 70. This is equal to 0.214 or 21.4%. Now let's summarize the unit. The majority of investors are risk averse and want to get the most out of their money while taking the fewest risk possible. The greater the risk that a person is willing to face, the greater is the potential reward. The investor analyzes prior experience to estimate risk, adapts it properly for projected future changes, and then produces a subjective probability distribution of prospective returns from the proposed investment. The expected value of the return and its variability are then estimated using this probability distribution. The expected value is given by the mean, while the variability or standard deviation is given by the variance or risk measure. The mean variance technique is a commonly used method for measuring risk. The variance, often known as the standard deviation, is a measure of risk. It calculates the overall risk and several factors that contribute to the total risk. To understand the impact of these components individually, a decomposition of total risk would be required. When it comes to defining the elements that influence total risk, there are two major categories to consider: factors that produce non-diversifiable or systematic risk, and factors that induce non-diversifiable or unsystematic risk. The first group includes factors such as interest rate fluctuations, inflation, and market mood or bull-bear market, all of which have an impact on all businesses and can be measured to help determine the required rate of return. The causes such as the business environment, financial leverage, management quality, liquidity, and the risk of default would fall under the latter category. They have an impact on certain businesses but not on all. These sources of risk are unlikely to have a significant influence on a well-diversified portfolio. Therefore, they're not worth worrying about. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 014 Financial Management. Course coordinators Professor K. Ravi Shankar and Professor Kamal Wagricha. Voiceover by Harpreet Kaur. Edited by Savita. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.